$1 billion. That's what most reports believe esports made in revenue during 2019. Esports has turned into a big business over the last few years as the number of viewers, competitive game titles, and franchise leagues have increased by an enormous amount. All of that has led to a massive influx of money. Prize pools, player salaries, and company valuations are all rising fast, perhaps too fast. Those numbers have led to a fear that the growth isn't sustainable. We've seen reports that esports has become a bubble that could pop with disastrous consequences. A recent Kotaku article referred to the injection of cash into esports as a structural problem that's coursing through the veins of the esports industry. So is esports in the midst of a bubble? Not exactly. But the answer is pretty complicated. A bubble occurs when a group of assets sees their prices escalate beyond their true value. A good example is the dot-com bubble of the late 1990s. In those early days of the internet, a company could raise capital simply because it owned a domain name. Investors didn't know what value to assign to those domains, so they rushed to fund nearly any company with a website, even if that company hadn't made any money and didn't have a plan to do so. In esports, we've certainly seen prices escalate to jaw-dropping levels. In the latest Forbes esports valuation published in late 2019, TSM and Cloud9, two of the biggest esports brands, are tied for first place. Their individual valuations were $400 million each. C9's valuation increased nearly 30% from the year before, while TSM's rose by a whopping 60% over the same period. That's major growth, and probably why some people are wary at the numbers. There's another reason to be concerned. It's a pretty open secret that most esports businesses don't actually make money. For example, as player salaries have increased over the past few years, team and league revenues are still relatively minor. That means many, if not most, esports teams actually spend more money than they make every year. Negative earnings may make high valuations appear unrealistic, but there are two reasons that isn't necessarily the case. Esports is still in a very early stage of development. Even some of the biggest esports organizations are less than a decade old. Lots of early-stage startups in a variety of industries get tremendous amounts of funding before they're profitable. That isn't unique to esports. The second reason for optimism is the recent establishment of franchise leagues like the League of Legends LCS and Overwatch League. These structures create stability for the industry and make the teams uniquely valuable by limiting the number of available slots. Valuations of most traditional sports teams aren't necessarily driven by team profits as much as they are by the value of owning a rare and prestigious asset. Esports leagues were smart to copy that tried and tested method. This isn't to say that esports investments are sure things. After all, the fourth richest organization on the 2018 Forbes list, EchoFox, was disposed of a year later in a fire sale for just over 1/5 of its former value. Investors still have to be wary of misleading data, lazy valuation analysis, and unscrupulous actors. EchoFox's failure, despite having an LCS slot, is a warning sign that franchise leagues aren't built on foundations of stone. For example, while Overwatch League continues to expand and even had its last grand finals broadcast on network TV stations ABC and ESPN, there remain big concerns over the underlying popularity of the game and Activision Blizzard's leadership in the space. Those could determine the league's success or failure. Finally, it's important to remember that esports isn't just one or two leagues and the associated teams. The $1 billion that the industry made in 2019 was split among thousands of businesses, most of whom don't field rosters. There are analytics companies like Mobalytics and OP.gg, technology companies like Overwolf and Blitz, and media companies like, well, .esports. The key is that investors need to understand what role a business will play in the industry and how it will eventually make money. But that doesn't make investing in esports different from any other field funded by venture capital. One of the biggest esports success stories, for instance, isn't a team or league, it's Twitch. The site, whose success was largely driven by esports titles, sold to Amazon for $1 billion in 2014. That's a lot of money back into investors' pockets, and an early indication that esports investments can provide a return. And of course, let's not forget about the heart of the industry itself, the games. As we noted in a recent video, League of Legends, which is more than a decade old, is still the most popular game on Twitch. Esports games aren't slowing down at all. In most venture industries, the number of failures far outweighs the successes. And that's okay because of the lucrative returns that a single success can create. Both those in the industry and those investing need to learn from those failures. Founders should have an eye on profitability and make sure they're not raising more money than they can repay. Investors should be wary of the buzzwords and numbers being thrown around in pitch decks and make sure that what they're looking at is real. Undoubtedly, there are some companies that have been funded on dodgy numbers, and even some well-run esports businesses will fail because the industry is young. But that doesn't mean that a bubble is bursting. Esports as a whole will be fine because it's driven by growth in gaming and new ways of consuming entertainment. If those trends continue, the true value of esports companies should be much higher than what they are today. In other words, just the opposite of a bubble.